This is the Kestrel Country Podcast, where we discuss the people, places, and events all around Kestrel Country. Hey, Tiffany.
Hi, Mike.
Thanks for coming in.
Yeah, thanks for inviting me.
Yeah.
I'm excited to be here.
Yeah, so we are just going to talk a little bit about the market. I don't know about you, but people ask me pretty much every day.
Oh yeah, I can't leave the grocery store line or go to a family barbecue without being asked what's the market doing? What do you think my house is doing? I'm like, can I just eat my burger at the family barbecue?
Exactly. Well, so what's the one sentence answer you give people?
Oh, hang on. It's not going to be terrible, but I think that I heard the best analogy for the interest rates lately, and it was that we're dating these interest rates, but we're not marrying them. So,
that's a good analogy.
I thought so too. So I was like,
because they came down today, I think a fair bit.
Yeah. So I think that even if they're locking in at that interest rate that they're in right now, chances are the interest rates are going to come back down, and those are the ones that you can marry into.
Yeah, there you go. Well, and that probably a similar analogy being used for the ARM mortgage, which I know is becoming much more popular. The adjustable rate mortgage, that 10-year adjustable rates are becoming pretty popular right now because the rates can be a fair bit lower than your 30-year, and then 10 years is a long time.
Yeah, I mean, I've been doing this a long time. You've been doing this a long time. And, it used to be that people would buy a home and they'd live in it for 30 years. And, people's average life, kind of their story in a home anymore is about 7 years. So, the ARM makes sense for if you're going to lock it in, you can buy more house, you can spend less in interest. Why not?
Yeah, no, absolutely.
And in that 10 years, the interest rates are probably going to change. So if you decide you want to lock it in for 30 and it's going to be your forever home, then you have the opportunity to do so.
Yeah, I feel like it's almost rare to even the 7-8 year mark is a fairly long time now for people to be in a house, which is interesting. Because I was just talking with somebody about employees too, and same thing now. People move jobs all the time, and at one point at my dad's business in Michigan, they had the average employee had been at the company for 25 years. The average, right? And it's that's the way people were. They just kind of settled more, and now we're much more mobile and we move and change. So I think people shouldn't be afraid of that.
No, I agree. And people, I think nowadays, instead of just buying the one forever home and then making it work, people buy different houses for different chapters of their lives now. So, when they're first starting out, they buy that cute starter home and then they start a family and it's oh my gosh, we need a basement with a playroom, and then as they get older, they're I don't want to clean the basement anymore. So people adjust for their lifestyle now.
Yeah, the idea of a dream home is kind of
fluid.
Not a myth, but yeah, exactly. There are very few homes that are going to be your dream home through many those different stages of your life. Yeah, for sure.
For sure.
Yeah. Well, that's good. So ARMs, things are changing. I know for me, it feels people have been asking me the same question, and what I tell people is, everybody wants to ask, is the market crashing? Is it dropping? What are you seeing? I said, honestly, I feel like the market is normalizing.
I do too. Yeah, I think it went too crazy. So it feels like we went from one extreme to the other, but in all honesty, I think we went from extreme to normalizing. I agree.
Yeah.
Things buyers are finally getting an opportunity to take a breath and go and look at a home a second time instead of in 15 minutes, make a decision because there's already 5 offers.
Yeah.
So they're getting to make that educated decision, and which I like as an agent because it's this is a really big investment and it should give you pause to make sure that you're making the right one versus this is the only one.
Yeah. Well, and days on market is probably a really good illustration of that, of what's happening. Earlier this year, beginning of the year, it was days on market were 3, 4. And that was kind of average. A lot of places were selling first day on the market. And now I was just looking at it, and for the current active, the average is 43 days on market.
For Latah County?
For Latah County,
That's
residential.
Interesting. That's
across all residential from that does include manufactured homes on rented lots. It includes condos, townhouses. But yeah, things have ticked up quite a bit. And then I think also just kind of show how quickly some of that's changing. Of the current pending, only 17 days on market. So, which is kind of showing, what would you say, like a 45-day history snapshot?
Yeah.
It's like, these are the places that have been under contract.
No more than 60.
Yeah.
Yeah.
And so that was kind of those were all on the market pretty short period of time compared to what things are sitting now. And that's still an average is a good thing to remember because, I mean, you're talking about, things normalizing a little bit. I wrote an offer over the weekend and didn't get it accepted. And the one that won was like way over asking, no inspection, no, like all the old stuff. So there's still a lot of competition.
For sure.
And, some places, if they're priced correctly, are still selling in a day with multiple offers.
Yeah,
right?
People still need homes, and I just took a real estate class. I mentioned this in our office meeting last week, but I thought it was interesting. I was in a real estate continuing education course, and the instructor asked everybody from around the state, there was like 50 people in the class, to look up the average days on market and the local inventory for each person in the class, their respective inventory. Yeah. And I was the only one from Moscow, but there was people from Coeur d'Alene and Sandpoint and all the way over by the Teton Valley and Nampa, and Moscow still had the lowest days on market and the lowest amount of inventory. So, we're not kind of following some of those nationwide trends, we never really have in my career. We're pretty much in kind of a protected bubble, so to speak, with 2 major universities, Schweitzer Engineering, the hospital.
Yeah.
So we always tend to, be fairly competitive and so people are still going to need homes. You're going to have to pay a little bit more in interest rate, but, we're paying that all across the board, not just in housing, gas, food. So, and like your dad, I think we mentioned this one time in a podcast, it got crazy for a while because housing kind of had to catch up because like your dad had said, like, look at the cost of a new pickup. It's $100,000.
Right.
In respect, applying that towards housing. And it was like, you could buy a house for $225,000 and a pickup for $100,000.
Yeah, no, absolutely. Well, and those construction costs, you brought that up, are still high. Right? Not only construction costs, but construction delays. And we are in a small market here where we don't have I don't know if you'd call it overbuilding necessarily, but we just don't have the amount of construction that some of these bigger markets do. Yeah. And even look at the local, we've had a couple of big developments that we've talked about on the podcast too. Yeah. And neither of those have any homes yet, right? Like this spring was really wet. They've seen delays. And so they also have the ability to pump the brakes a little bit. Right. If things, if interest rates continue to rise, if things do slow down, we're not going to be sitting on half-built subdivisions like you see in some of these other markets. And so I think the supply side is going to stay under control. And I'm with you. I mean, the demand here is going to be really strong.
It's still going to stay high. And we don't have the same infrastructure like some of these larger markets like Coeur d'Alene and Boise where they've got, massive contractors where they can pour 20 foundations at once and frame 20 houses at once. I mean, let's say we have an average of, to say 10 builders in town who could build 3 specs. So that means we could really only see new growth of about 30 homes a year. But people are moving here more than 30 homes a year. So that keeps our kind of used homes, so to speak, at a relatively competitive price.
Yep, absolutely. Yeah, it's interesting to see how things have been affected, from such super low inventory earlier this year. But one of the things I did was pull some data from this year to last year. Mm-hmm. And I thought it was pretty eye-opening, honestly. Overall, because if we think back, last year was really, really hot, especially this time of year. It was insane. Inventory was super low. But we're actually, overall inventory has actually dropped in residential.
That's interesting.
In Moscow.
So you always pull stats more. I don't have to do that part because I know you'll do that part.
From the first half, if we look at the first 6 months of this year versus the first 6 months of last year, actual inventory, active inventory over that period of time, down 9%, which is pretty interesting. Yeah. Now, that is total active inventory over 6 months, which was 316 this year, 349 last year. So that doesn't talk about current, like, static inventory.
Right, yeah.
That's the right word.
Yeah.
basically it's like there might have only been a handful of homes on the market at any given time, but there was just that much more activity. Things were churning very fast.
Yeah.
So that doesn't necessarily tell us the current active inventory, but that is pretty interesting. Average sale price 1 year ago, though, compared to now, and this is for Latah County. Right. This is not just Moscow. This is all of Latah County and all of residential.
Because the outerline communities
20%
have performed so well.
Yeah.
Genesee, Troy, and that's probably where you're seeing some of that uptick too.
Yeah, and that's, I think, one of the interesting things to look at if you're thinking about the market in 2022 as a whole, right? So what I'm saying is right now, for the first 6 months, we're up, average price is up 20%.
Yeah, that's
huge.
That's huge. Yeah.
So we have a lot of, even if prices don't go up at all the rest of this year, we're still talking about a substantial increase in value 2022 over 2021.
Yeah,
so people aren't, it's not like anybody should panic, think, oh, we're losing value in our homes, home values are dropping.
No.
Prices might drop, right? Like there's some people who've overpriced their homes that are having to correct that, but it doesn't mean that value's dropped over what it was last year.
No, because what I was just going to say was, sorry, I didn't mean to cut you off, but
no, not at all.
Was, throughout my career, when we did a market analysis, and let's say if we used a comp from 9 months to 12 months prior, we would generally give around 5% appreciation. So when you look at that 20% mark and you see prices coming down now, in all honesty, it's been really hard for agents to price houses in the prior market, like say from 6 months ago, because it was such a competitive market. And so I think that some of that was just that bidding frenzy. So I don't think that prices have come down, really. I think it's just the hype has kind of leveled off, which makes it feel like the prices have come down. But what I tell especially my younger families that are buying, or my young families that are buying, is that even if you feel like you're slightly out of your comfort zone on pricing, I still say it's a great investment, because look at that 20%. So if you bought a house, at $400,000, you've just gained $80,000 in value in 1 year. And that's kind of like a savings account. I tell them, your house is kind of like a savings account. You can't save and put away that much money as a young family in a savings account and earn $80,000. But let's say they stay there for 3 years, they walk away with, $150,000 in value and go buy the next bigger house.
Yeah, absolutely. Yeah, it's always looking at it as cost benefit or trade-offs, right? And what your rents are also going way up.
Yes.
Right? We've talked a lot about that.
Yeah.
Rents have been fairly level here for a while, and they've really started to hockey stick up, and I think especially with the rise of interest rates, all the assessments just came out, all our property taxes went up. I mean, rents can't help but go up. They have to.
They have to, unfortunately. And the rents have gone up, and I knew they were going to go up because last year the investment properties started selling like crazy after everybody locked in their leases. And I was like, oh, geez, let's see how the rental rates go come renewal season. And then right around that same time, the tax levy or the assessments came out, and it was just, that's all that my clients asked about for a while. How can I give data to the county? And I'm like, you're still right around where they should be, unfortunately.
I know. Yeah, that's the thing is, speaking of assessments, right? I would say generally speaking, properties have been underassessed.
For sure.
For a while, right? And so I had somebody as well ask me about that. And it's like, honestly, I think that number, it's way higher than it was a year ago, and that's no fun. But that's still probably under what I could sell it for today.
Yes,
for
I
sure.
agree. Yeah.
And so it is tough. But all that is to say, those rental rates are going to go up. And how many people do we know who sign 10-year leases at a fixed, right? No. They don't. No. In commercial sometimes.
Except for me. I have one tenant that has been she was on the same rent for 10 years. Finally, after 10 years, I said, I love you, but I have to raise your rent just slightly.
Well, good for you. But it is one of those, it's like, it's everything's going to go up, but if you're not, your rental rate isn't locked in, that's going to go up significantly next year. Not only that, but they don't have to renew that lease either. No. And so for somebody who needs a home, it's one of those things that you need to think of. yes, it can be an investment, but it's also an expense. It's an expense for where you're going to live. And you can't always think about, oh, this is something I'm buying and it's going to make me all this money. It's going to make me 5 to 10% every year. That might not always happen, but at the end of the day, you have to have a place to live. And so it's kind of one of those things you just have to factor in and, like you said, make it happen.
And I would always encourage people to be homeowners versus renters. I mean, renting serves a really good purpose, and it works really well for some, but for most of our clients, it's like you're already paying a mortgage. It's kind of that like next leap, just that next step of responsibility and, kind of the unknowns. But, you just budget for those a little bit and kind of prepare for that.
Yeah. Well, and one of the things I think that I've already seen or thought more in my own mind that is changing back towards a more normal market is when I first got into real estate, I would tell somebody might come to me, and we're in a college town, right? So there's a lot of people coming and going. I said, well, what do you think? Should we rent or should we buy? And I wouldn't always tell them to buy.
No.
Because, especially in a town like this, if you're only going to be here for a couple of years, you might not be able to make that money back. Now, the last few years, the market's been such that you're going to make that money in a year. And so even if you thought you might move next year, yeah, buy the house and see. But I think we're coming back into that more normal market where that's one of the considerations you have to make is, well, do you think you're going to be here for a few years? Because by the time you deal with closing costs and everything else, it might not make sense for you if you're only going to be in a place for 2 years. It might take that 2 years, like say at a 5% appreciation, to actually make your money back.
Exactly.
And so I think that's one of those things is becoming a little more normal. What have you seen from an investment property standpoint? I know for me, I like last year had a ton of people looking for investment properties. What about you?
Yeah, last year it didn't even financially make sense for a lot of my, long-term investors. It was really hard. I mean, it was a really competitive market. I sold that fourplex for a sweet family that I've worked for a long time, and it had some deferred maintenance. And we had 27 showings in 48 hours with multiple tenants. It was just insane. It was insane. And then we ended up with 17 offers, and it went $100,000 over asking. So it was just like, oh my gosh, so the investors who want to invest, where they maybe had a larger portfolio, I just saw them being like, I'm good. I'll just step back and kind of
interesting
and watch and see where this goes. But the ones that kind of wanted to dabble, get their feet in the market, they kind of were like excited to do so. And they're still going to make money, they'll adjust their rents and they'll fix up the property. And, but we definitely saw I saw a lot of more like, young investors trying to come into the market. And I am such an advocate for, let's say if you can't afford our starter level prices in town, is to become a duplex owner. That's how my husband and I got started into investment properties. And I actually wish now I knew what I knew now versus back then, because we would have bought a duplex every year for 5 years and lived in one side and rented out the other, because you can do that for 3% down, as little as 3% down, versus as an investor, you have to put 20 to 25% down. So I'm already coaching my 13-year-old daughter that her first down payment needs to be on a duplex, and then she has to move a year later.
There you go.
She's like, so I have to do that for 5 years. I was like, yes.
There you go. Yeah, it's true. And I think we saw a lot of, and I think some of them, like you said, it was hard to make those investments pencil on paper at the time. At the same time, knowing, and I think a lot of investors, sure, young people, but even more seasoned investors knew that these interest rates weren't sustainable.
Exactly.
And so when you're talking about an investment property that you're going to probably own for 30 years, and you can lock it in at 2.875% or whatever, I mean, it was almost a no-brainer. Right? With inflation going up and everything else. I've definitely seen a fall off in the number of investors. And I think that'll be an interesting dynamic to how that affects the market, because that was one of those things that we saw here, like you said, mostly kind of the onesie twosies, smaller investors, but nationwide. I mean, we were reading articles about places in Texas where corporations were buying up whole tracts of homes. Just the investment money going into real estate the last few years was enormous. And if that pulls back, that really could slow things down quite a bit and affect things. But again, because we weren't seeing that here, I don't think it's going to have the level of effect that we see other places.
Yeah, and I honestly believe that like after 2008, and they lowered the interest rates, to kind of recover the housing market, because the best way to stabilize a economy is with housing. Honestly, I think that our interest rates should have been where they are now. They should have had them go lower to help adjust the market, activate some momentum, and then they should have been upticking them slowly, because in perspective, a 5.5% or a 6% interest rate is cheap. It's still cheap money, but we were so spoiled for so long that we became kind of an entitled buyer's market. It was 4%. And so they just held them too low for too long. I think we wouldn't have seen this drastic they threw the car in park when it was going down the freeway at 65 miles an hour. And so when we should have just been slowly, kind of tapering the interest rates. So honestly, I don't think the interest rates are terrible. Those who are locked in still at the 3%, we're just lucky.
Yeah.
I think.
Absolutely. Yeah, I think that's definitely true. What about people are often asking, isn't this going to be just like 2008? Doesn't feel like 2008. Feel like to talk about their feelings, right? It feels like 2008 to me. You were selling real estate through that time.
I was.
What do you think? What are you seeing?
Yeah, I don't feel like it's 2008 at all. I feel like in 2008, it was ridiculous, I guess would be the best word to describe it. You had stated income loans where you didn't even have to substantiate how much money you made, or you wanted to roll in your $50,000 boat purchase for Lake Coeur d'Alene into the property, and it was like, hey, let me get my appraiser buddy friend. There was no checks and balances. So there's a reason that 2008 happened, because it was just kind of it was whatever you stated is what you got. And so I agree with a lot of the checks and balances that have been put in place. One of the things that's made it hard is the appraisal timelines, there for a while, because we have a shortage of appraisers, and that's one of the things that came out from the housing fallout. But I think nowadays people are better equipped, and lenders have more regulations in place, which I'm not always a fan for regulations, but in that regard it needed to be, because if your entire neighborhood is going into foreclosure, like in Boise, there was neighborhoods where the whole neighborhood was going into foreclosure, and those houses are selling for 50 cents on the dollar, and you're hanging out and waiting on your home. That really affects your value. So not only does it just affect the neighbor's, kind of buying position, but it affected your asset as well. So I feel like we're in a much stronger position. I think people are just kind of in a holding pattern right now, kind of like what's going to happen.
Yeah. Well, and real estate is local, as we've talked about, and locally here, when I've looked back at it, and correct me if I'm wrong, but it seemed like at the worst, from the top to the bottom, certain segments of the market lost about 10% of value.
At most.
Would that be right?
Yeah.
Yeah, let's say at most. So let's say you got a $400,000 home. It might have lost $40,000 worth of value. Well, to put that in perspective, we were just looking at it. Just in this first 6 months of this year from the first 6 months of last year, people gained 20% of value.
Yeah, you're still at 40. You're good.
So even with a correction, if we see a correction, we're not seeing anything like these major markets where it's wiping it all out completely.
No.
And I think that's one of the things that people need to keep in mind is you're never going to time it perfectly. And let's say you do buy at the top of the market because you need a home and that's where you're going to raise your family, and you just have to get a home, right?
Yeah.
What's the worst that's going to happen? You lose some value, you regain that value if you're going to be there for a little while. Long-term, real estate is a great investment, and I think that's something that people just need to keep in mind and kind of keep their heads and see what opportunities are out there.
Yeah. And, that's why I think this podcast is really helpful for folks, is just talking about the local market, because everything that we read on the news, on Fox News or MSN or whatever, those are nationwide, and they're generally picking the big cities, where they have thousands of homes for sale and thousands of buyers. And we don't have that, and so, I might have mentioned in a previous podcast, in 2008, we were just talking about, I had asked the title company, because I had been in real estate like 4 or 5 years by that point. I said, educate me. Like, what does the foreclosure market look like in our local market? And they said, and there were so many homes like in Boise, Phoenix that were going into foreclosure. And they said, in a normal market outside of 2008, county-wide, so they said we might see 1 foreclosure a month. And then in 2008, they said we might see 3 a month, like 3 for the whole county. And like right now, we don't see foreclosures at all.
Yeah. Which is still, on a percentage basis, that's huge, right?
Huge, yeah.
But in a small market, that's really a relatively small amount. It's not going to affect everybody, right?
No. So the point of that is, is that the local market here is strong. It's worth investing in. You might be overpaying slightly right now, but I tell my folks, like, who cares? You're going to overpay it, whether it's going to be in rent or in a payment. And so, I would rather see them invest in their own future and their own savings account and just to make educated decisions, meet with your lender. And, we've got great lenders in town.
Yeah, no, I think that's absolutely right. And being educated, look at the data yourself, look at a lot of homes. And that is one of the things that we're getting more of that luxury to have again.
Yeah.
Is, it's like I used to show somebody the same house 3 times before they'd make an offer, right? It's like, yeah, we want to think about it, go back and see it again. And that's starting to be possible again, which is really good.
I showed the most amount of homes when I was pregnant with my first daughter. I was 9 months pregnant, and I had a guy coming in from California, and he was kind of a researcher dude. And I showed him 27 houses in 6 hours, 9 months pregnant. And I was like, do we have to see all 27? First off, it's like hysterical now to think back, like I actually had 27 houses to show.
Seriously.
And then we pulled up to the 17th house, and he said, this is the house I told my wife we were going to buy. And sure enough, that's the one they bought. And I was like, well, we could have avoided looking at 26. But like now you only have maybe a few houses to look at.
Yeah.
So 27.
That's the thing. Our inventory has been increasing a little bit, but it's still really low.
Yeah.
Still really low. And Moscow's a great place to be. And I think the work from home thing is going to stay fairly consistent as well. And that's allowed a lot of people to move here. And the fundamentals of our economy here are pretty strong.
And it's a great place to raise a family or a great place to retire or just whatever your flavor is. Generally, our community has the blessing to offer it.
Yeah, absolutely. Well, thanks, Tiffany.
Yeah, thanks for having me.
Yeah.